Welcome to the research desk.
Glad to be here for this one.
So today we are talking about a rock. I really want you to visualize it sitting in a vault. It pays no dividends. It produces no cash flow. There's no chief executive officer trying to compound shareholder value, no quarterly earnings calls, no technological innovations. It just sits there, completely inert.
Right, just a very heavy, shiny paperweight.
Exactly. Yet I want you to consider the sheer statistical impossibility of this asset's history over the last 55 years. On August 15, 1971, this inert metal was priced at $35 an ounce. Today, we are staring at a market price of $4,591.
Wow.
Yeah, that is a 131 times return, and if you stop the analysis right there, you might logically conclude that gold is the ultimate untouchable wealth preserver in modern finance. But, and this is crucial, that completely ignores the dark side of the data.
The massive drawdowns.
Exactly. This exact same asset suffered a grueling, wealth-destroying 70% collapse that dragged on for 2 decades. And later, it suffered a violent 45% drawdown compressed into just 4 years. So what is the actual truth of this asset? The central tension we are resolving today is gold's dual identity. Was gold ever truly a reliable inflation hedge, or has it always been a monetary debasement and fear trade that Wall Street merely rationalized after the fact?
Which is a profound question when you're looking at allocating capital today.
Right. So, my thesis is that gold absolutely does not move randomly. It's not a purely psychological phenomenon or a barbarian relic traded on emotion. I argue it is governed by a measurable, highly rational 3-pillar framework. First, a hedge floor that mathematically prices in monetary distrust. Second, an arbitrage premium dictated entirely by real interest rates and equity market returns. And third, a structural bid driven by physical constraints and sovereign buyers. When you map these 3 pillars, every seemingly chaotic surge and catastrophic crash in gold makes perfect mathematical sense.
Well, the mathematical framework you are outlining is, it's elegant, but it is entirely too clean for the brutal reality of what actually happens in the financial markets. My counter thesis is that gold's history is not defined by polite macroeconomic recalculations. It is defined by panic, leverage, market plumbing, and narrative blow-offs that repeatedly outrun their underlying fundamentals.
So you think the math is just hindsight bias?
Largely, yes. You cannot place gold in a sterile vacuum of opportunity cost and money supply and expect to understand why it drops 45% in a matter of months. When gold moves to extremes, it is not acting as a rational thermometer of inflation. It acts as a transmission event for systemic stress. The most extreme price actions in this asset are driven by futures positioning, exchange-traded fund flows, collateral margin calls, and forced liquidations. A math model explains the math in hindsight, sure, but it completely fails to capture the behavioral violence that dictates gold's actual trading history.
Okay, well, to test that behavioral theory, we really have to look at the foundational metric of the framework. Because I do not view gold as a theoretical concept, I view it through the gold to M2 ratio.
The famous heat gauge.
Right, the heat gauge. For the listener, M2 is essentially the total amount of money circulating in the economy. It includes all the physical cash, the checking accounts, the savings accounts, and easily convertible money market funds. We calculate this ratio by taking the price of an ounce of gold and dividing it by every $1 trillion of M2 money supply.
Making it a relative value metric, essentially.
Exactly. I present this not as an abstract academic theory, but as a precise heat gauge for the asset. Over 55 years, the valuation bands on this ratio are strikingly consistent, and they map perfectly to reality.
Walk us through the bands.
Sure. When this ratio falls below 80, gold is in deep value territory. Between 80 and 120 is undervalued. Between 120 and 160 is fair value. Between 160 and 250 is the hot hedge zone. And anything above 250 is an extreme hedge. The history of the market fits this map with absolute precision. In 1971, the ratio sat at 50, deep value. By 1980, it exploded to an extreme of 531.
Which is just an astronomical number.
It is. And today, as we look at this asset pushing past $4,500, the ratio sits at 206. That places us squarely in the hot hedge zone. It is elevated, yes, but it is entirely justified by the massive expansion of the money supply over the last decade and the current macroeconomic risk profile. The thermometer works.
Look, I will acknowledge the elegance of the gold to TEM2 thermometer. It provides a highly useful baseline for where the price ought to be if the market were a perfectly closed system. But I reject its completeness. I want you to think about a levee breaking during a severe storm.
Okay.
Measuring the water level, which is exactly what your M2 calculation does, tells you that the river is high. It tells you there is immense pressure on the concrete infrastructure. But measuring the water level does absolutely nothing to explain the violence, the speed, and the sheer destructive force of the flood once the levee actually snaps.
So you're saying the metric measures the potential energy, but not the kinetic reality.
Exactly. Stating that a ratio above 250 is an extreme hedge is a remarkably sterile way of describing sheer human panic. When gold experiences its most explosive upside moves, it is not because institutional investors are sitting at their mahogany desks calmly dividing the spot price by the M2 money supply and allocating accordingly. They are buying because a narrative of terror has taken hold of the market psyche. The price action itself becomes the fundamental driver.
I get that, but to understand the origin of that price action, we have to go back to the catalyst that started the modern financial era. We have to examine August 15, 1971. President Richard Nixon abruptly goes on television and suspends the convertibility of the U.S. dollar into gold. The Bretton Woods system, which had anchored global finance since the end of World War II, is functionally terminated.
The closing of the gold window.
Right. Gold is instantly liberated from its administered $35 peg. Think about the gravity of this moment. This is the exact second gold transitions from being a fixed, boring anchor in the global monetary system to a live, fluctuating referendum on the credibility of fiat currency itself.
It became a floating vote of no confidence.
Precisely. And the macro conditions that followed provided the perfect environment for a rational, sustained repricing. We saw the 1973 OPEC oil shock, which sent energy prices soaring and strangled global growth. Then we saw the 1979 oil shock. We had the Soviet invasion of Afghanistan and the Iran hostage crisis, injecting massive geopolitical instability.
A perfect storm of bad news.
Right, so build the tension using the data from that single decade. The United States Consumer Price Index hit an astonishing 14.8%. Simultaneously, the S&P 500 lost 40% of its value in real, inflation-adjusted terms between 1968 and 1982. This is the perfect mechanical alignment of my framework.
How so?
The hedge floor rises aggressively because the currency is being visibly debased and global geopolitics are fracturing. The arbitrage premium swings massively in gold's favor because real interest rates, the yield you get after subtracting inflation, are deeply negative, and equities are bleeding purchasing power. Gold's historic surge from $35 to $850 by January 1980 was an entirely justified rational adjustment to those specific inputs.
Justified. Calling the 1980 peak a justified macro adjustment completely ignores the reality of what happened on the trading floors in the final months of that decade. Let us look closely at your own metric. The gold to M2 ratio hit 531 in early 1980.
Right, which I classified as an extreme hedge.
But 531 is an absolute, undeniable extreme. It is a level we have seen exactly once in 55 years. A ratio of 531 is not a polite hedging adjustment against the consumer price index. It is a statistical anomaly born of pure market hysteria. The initial move from $35 to perhaps $400 might be explained by your hedge floor and the fact that real rates were negative, but the violent, parabolic move past $800?
You see that as purely behavioral.
That was pure reflexivity. Reflexivity is when the rising price of an asset creates a narrative, and that narrative brings in more buyers, which drives the price even higher, divorcing the asset entirely from its fundamental value. Rising prices validated the fear narrative of the late 1970s, drawing in massive waves of retail and speculative buyers, creating a self-fulfilling fear spiral.
But Wall Street literally termed it an inflation hedge.
Sure. Wall Street looked at that parabola and called it an inflation hedge because that sounded professional in a prospectus. In reality, it was panic feeding on itself. Do not forget the Hunt brothers were actively attempting to corner the global silver market at the exact same time, which threw the entire physical commodity space into a speculative frenzy. Leverage was driving the marginal price, not long-term asset allocators. That blow-off top to $850 was not an arbitrage equation balancing out. It was a behavioral malfunction.
Okay, but even if we classify the absolute peak in January 1980 as a behavioral overshoot, the underlying macroeconomic structure still dictated the direction of the trend. And that exact same structure perfectly explains the massive regime shift that followed. The fear spiral of 1980 slammed into a brick wall named Paul Volcker.
The ultimate party crasher.
Exactly. The new chairman of the Federal Reserve takes control and implements a punishing monetary regime, eventually pushing short-term interest rates to 20%. He deliberately induces a recession to break the back of inflation, and it works. Inflation subsequently collapses from that 14.8% high down to roughly 3%.
And gold pays a price.
It does. What happens to our inert rock? Gold begins a grueling secular decline that lasts 2 full decades, eventually bottoming near $250 an ounce by 2001. So why did gold essentially die for 20 years? The framework explains it flawlessly through the arbitrage premium.
Because of real rates.
Right. Volcker's policies caused real interest rates to turn massively positive. Suddenly, an investor holding cash or government bonds yielded a tremendous risk-free return above the rate of inflation. At the exact same time, equities began a historic secular bull market. The S&P 500 went up 14 times from 1982 to 2000. Capital naturally and rationally migrated away from a non-yielding piece of metal.
The opportunity cost just became too high.
The opportunity cost of holding gold became catastrophically high. As a result, the gold to M2 ratio collapsed out of the extreme zone, slowly and steadily draining all the way back down to the 50 to 77 deep value zone. This was a sustained, rational migration of capital toward productive assets with superior real return prospects.
You are describing a clean opportunity cost equation, but you are actively avoiding the uncomfortable truth of that specific era. Let us look closely at the inflation data you just mentioned. During much of the 1980s and early 1990s, the Consumer Price Index was actually still running relatively hot by broad historical standards. We were consistently seeing inflation prints of 4, 5, and even 6%.
True, inflation didn't go to zero.
Exactly. So if gold were truly a mechanical inflation hedge, if it was a simple math equation balancing against a debasement of the dollar, it should have maintained a strong baseline bid during those years. 4 to 6% inflation degrades purchasing power incredibly fast. Instead, gold failed spectacularly. It bled out year after year, completely ignoring the fact that the dollar was still losing value.
Because the real yield was positive.
No, it was more than that. This was not just a mathematical reassessment of real yields on a spreadsheet. It was a regime-level narrative collapse. Society fundamentally stopped viewing gold as necessary money. Think about the cultural shift. The Cold War ended, the Berlin Wall fell. The global trade order stabilized under an era of unprecedented globalization, and the public imagination shifted entirely toward the internet, technology, and sophisticated financial engineering.
So gold just became uncool?
Gold was discarded as a barbaric relic of a paranoid past. Your math model brilliantly explains the capital migration, but it completely fails to capture the cultural and political abandonment of the asset. When the psychological belief in gold as the ultimate safe haven fractured, the price action decoupled from inflation entirely. It proves my point. Without the narrative of fear, the underlying math is impotent.
Well, the narrative only shifted because the institutional framework of fiat money temporarily regained its credibility. But that credibility is highly cyclical, and human institutions are inherently fallible. This brings us to the next profound shift in the market, the 2000 stealth bull market and the 2011 quantitative easing terror.
The revenge of the rock.
Exactly. From that deep value low of $270 in 2001, gold surges 7 times, reaching almost $1,900 an ounce by the late summer of 2011. Detail the catalyst that drove this massive repricing. First, we experienced the dot-com bust, which completely shattered the 1990s illusion of perpetual equity growth. Then we witnessed the geopolitical shocks of September 11 and the immense deficit spending of the subsequent wars in the Middle East. And finally, the granddaddy of them all, the 2008 global financial crisis and the unprecedented birth of quantitative easing.
Where central banks just started printing.
Exactly. This era proves conclusively that gold is not just a narrow, backwards-looking CPI inflation hedge. It is a hedge against institutional fragility. Investors watch the entire global banking system teeter on the absolute edge of insolvency. They watch central banks globally print trillions of dollars out of thin air simply to plug the gaping holes in commercial bank balance sheets.
The ultimate counterparty risk nightmare.
Right. And in response, the gold to M2 ratio climbed methodically back to 197. This placed it in the hot hedge zone, but crucially, it was not the 531 extreme we saw in 1980. It was a highly rational repricing of risk. Investors were willingly paying a premium for a scarce, physical asset with zero counterparty risk at the exact moment in financial history when counterparty risk became the market's biggest terror.
Okay, let us focus intensely on that exact moment. I want to drill down into the immediate aftermath of the Lehman Brothers collapse in September 2008. So what actually happened to gold when the ultimate fear hit? Think about this for a second. The global financial system was experiencing a genuine near-death event. Interbank lending froze completely. Counterparty risk was the absolute only thing anyone on Wall Street cared about.
Right, it was pure panic.
Pure panic. If your institutional fragility thesis is correct, gold should have gone purely vertical the exact moment Lehman filed for bankruptcy. It should have been the most highly sought-after asset on the planet. But it did not go vertical. It wobbled, and then it aggressively sold off alongside the very risk assets it was supposed to hedge against. Gold dropped from roughly $900 in July 2008 down into the low 700s by the fall.
Which was a massive shock to a lot of gold bugs.
It was. So why the ultimate safe haven crash during the ultimate panic?
Market plumbing. Let me explain how this actually works on a trading desk. Imagine you are running a leveraged hedge fund in September 2008. Your portfolio of mortgage-backed securities is tanking. Your prime broker calls you and says, I need $50 million in cash by noon today or we are liquidating your fund.
A classic margin call.
A brutal margin call. You cannot sell your toxic mortgage bonds because the market is totally frozen. There are no buyers at any price. What do you sell to raise that $50 million? You sell your gold. You don't sell it because you suddenly hate gold or because your macro framework changed. You sell it because gold is highly liquid, and the market will actually buy it from you. In a systemic shock, you do not sell what you dislike, you sell what you can.
So the correlation goes to 1.
Exactly. This forced liquidation proves that gold behaves less like a predictable macroeconomic spreadsheet and much more like a living ecosystem reacting to financial contagion. The macro thesis is always without exception at the complete mercy of dealer balance sheets and institutional liquidity constraints. When the financial plumbing breaks, the hedge floor falls out from under you entirely.
I will concede that the initial sell-off in the autumn of 2008 was a severe liquidity phenomenon, but it was temporary. The plumbing broke, yes, but it was quickly patched by the Fed. Within months, gold completely reasserted its role as a premier hedge, climbing rapidly past $1,000 by March 2009, while the broader financial system and equity markets were still desperately trying to find a bottom.
It recovered, yes.
The macro framework held true over the full cycle of the crisis. But I will agree that dramatic shifts in central bank policy expectations can cause rapid adjustments, which explains the brutal contraction from 2013 to 2018.
The next desert.
Right. Gold suffered a devastating 45% crash, falling from its $1,900 peak down to roughly $1,050 by late 2015. The macroeconomic explanation for this is incredibly clear, and it centers on the 2013 taper tantrum.
Bernanke's famous speech.
Exactly. The Federal Reserve, under Chairman Ben Bernanke,
officially signaled the eventual withdrawal of emergency quantitative easing policies. They signaled that the printing presses were going to slow down. In response, real interest rates spiked sharply. The widespread market expectation of runaway hyperinflation, which had priced gold so highly, completely evaporated.
The inflation ghost vanished.
It did. As the macroeconomic outlook normalized and the U.S. economy showed signs of robust organic growth, the institutional fear that had built up the arbitrage premium naturally dissipated. The fundamental hedge case weakened, and the price systematically adjusted downward to reflect the new reality of a stabilizing global economy.
I completely disagree with that framing, and here is why. Saying that inflation simply failed to arrive is an entirely insufficient explanation for a 45% wipeout in the world's oldest wealth preserver. A 45% drop is a catastrophic loss of capital. This was not a polite recalculation of forward inflation expectations by sober analysts. This was the Big Short mirror image.
The Big Short mirror image? What do you mean by that?
Think about the mechanics of the Big Short. A few contrarians rushed into a complex trade betting against the housing market while everyone else thought they were insane. The gold crash of 2013 was the mirror image of that. The entire financial world was crowded into the exact same sure thing trade. The absolute certainty that quantitative easing would instantly cause hyperinflation.
It was a very crowded trade.
Exactly. And when that consensus macro narrative finally broke, the unwind was not a gentle repricing to fair value. It was a violent race for the exit door. And the exit door was remarkably small. Look at the mechanical, forced selling that dictated this specific era. Gold exchange-traded funds, which had accumulated thousands of tons of physical metal, experienced massive, unprecedented outflows, dumping that inventory directly back onto the open market.
Creating a supply glut.
A massive glut, futures traders holding leveraged long positions faced severe liquidation events as the price dropped below key moving averages. Momentum-based algorithmic strategies violently reversed their positioning from long to short, amplifying the downside velocity. When the holders of the hedge all change their minds simultaneously, the fundamentals no longer matter. Everyone tries to liquidate at once. The severity of that crash was dictated entirely by leverage constraints, collateral requirements, and structural market mechanics, not just a logical reassessment of central bank policy.
Regardless of the velocity of the decline or the mechanics of the specific liquidations, the critical point is that the price ultimately settled exactly where the framework suggested it should. It fell back into a fair value equilibrium as the broad money supply grew steadily without acute, systemic crisis. And that specific equilibrium sets the stage for the reality we face today.
The $3,000 plus era.
Right. Let us examine the current era, from 2020 through to today. Gold is now trading at massive new all-time highs, surging past $3,000 and pushing aggressively toward that $4,591 mark. If we look at the thermometer, the gold to M2 ratio currently sits near 206, placing it squarely back in the hot hedge zone.
Which should terrify people.
Well, wait, the fundamental driver today is entirely different from the retail inflation panic of 1980 or the institutional quantitative easing terror of 2011. There is a hidden massive force at work here, and it is the ultimate validation of the structural bid pillar of my framework.
The central bank buying?
Exactly. We are witnessing massive, unprecedented official sector reserve diversification. Central banks across the globe, particularly in the global south and eastern hemispheres, are actively and aggressively de-dollarizing. They are systematically buying physical gold, taking it off the commercial market, and vaulting it to insulate themselves from geopolitical sanctions and the explicit weaponization of the US dollar system.
Which really kicked off with Russia.
Yes, this is a profound architectural shift in global finance. Consider the freezing of Russian foreign exchange reserves in 2022. That demonstrated to every sovereign nation that holding digital dollars carries immense political risk. Central banks buying physical gold for sovereign sanctions resilience are not momentum traders chasing quarterly returns. They do not care about a temporary 3-month spike in the consumer price index. They are permanently re-architecting their national balance sheets.
They are buying outside the traditional financial system.
Right.
This is profound geopolitical distrust, getting a permanent physical seat on the balance sheet. It forms a sturdy, durable, structural floor that mathematically justifies the current elevated pricing, even in the complete absence of a localized banking crisis or a 1970s-style domestic inflation print.
I fully acknowledge the reality of the central bank bid. The weaponization of the U.S. dollar network following the freezing of Russian reserves undeniably shifted sovereign behavior. It was a wake-up call for global reserve managers. But I must issue a stark, urgent warning about this $4,500 price tag.
Because of the ratio?
Exactly. You are looking at a gold to M2 ratio of 206 and confidently calling it a durable structural floor. I am reminding the listener of the iron rule of this specific asset. Do not chase a mania when it is visibly priced above extreme hedge conditions. At a 206 ratio, the market is paying an exorbitant, historic premium for a live insurance regime.
But the buyers are price-insensitive central banks.
For now, the narrative of global de-dollarization has left the realm of geopolitical theory and become a universal crowded market consensus. Everyone knows the central banks are buying. And a crowded market fueled by urgent, price-insensitive reserve buying is highly fragile, precisely because it relies on a single dominant buyer continuing their behavior indefinitely.
So what happens if they stop?
Pose the critical question to yourself: if that official sector buying visibly slows, if sovereign entities in Asia or the Middle East decide they have finally reached sufficient reserve neutrality and pause their accumulation programs, what happens next? The math changes instantly. The structural floor vanishes overnight. We might be witnessing the final parabolic blow-off of a de-dollarization narrative that has simply outrun its actual physical fundamentals. When the sovereign bid steps back from the market, all that remains holding the bag are leveraged speculators and trend followers who bought at the absolute top of the cycle. Without the central banks constantly absorbing supply, the vulnerability to a cascading mechanical liquidation event is immense.
That specific downside risk perfectly underlines the importance of applying this macro framework pragmatically to actual portfolio construction. When we synthesize these 5 decades of wild data, the actionable takeaways become incredibly clear. Gold should always be sized as insurance, not treated as a religion.
Amen to that.
The historical data strongly supports a tactical 7% allocation to gold in environments where at least 2 of the 3 pillars, the hedge floor, the arbitrage premium, or the structural bid, are visibly strengthening. But that allocation must be actively and unemotionally managed. You cannot simply buy it and forget it.
What's the trigger to sell?
The strict mechanical trigger to cut your exposure is a sustained rise in real yields. If 10-year Treasury inflation-protected securities, which guarantee a real return above inflation, hold between 0.5% and 2% for 2 consecutive financial quarters, the arbitrage premium is definitively turning against gold. That is your undeniable mechanical signal to reduce the allocation from 7% down toward a baseline 3%. You respect the math, you monitor the money supply, and you always respect the opportunity cost of holding an inert rock.
And my final synthesis is that while you monitor the math, you must fundamentally respect the mechanics of liquidity and human behavior. Gold is never priced by fear or macro fundamentals in a vacuum. It is priced by the precise, fleeting moment when macroeconomic mistrust becomes institutionalized in the market. And it is continually vulnerable to the hidden plumbing of the financial system.
The margin calls are always lurking.
Always. You can monitor the M2 money supply and chart real yields all you want, but if the collateral chains and the overnight lending markets break, or if a crowded narrative suddenly collapses under its own weight, the exit door will shrink instantly. The true, enduring lesson of the last 50 years is that gold's most extreme, violent moves, both its parabolic surges and its crushing drawdowns, are pure transmission events of systemic stress. It remains an essential, vital asset for a diversified portfolio, but is one that demands a deep, unvarnished understanding of market structure, leverage, and human panic, not just elegant mathematical ratios.
This is the Research Desk, officially signing off.